Hello, I'm Hans Lee from Livewire Markets, and welcome to Views from the Top, a premium conversation series looking at the issues that investors are talking about. Our guest today is Daniel Graña. Graña is a portfolio manager on the emerging market equity team at Janus Henderson Investors, and he has more than 30 years experience in the markets. Daniel, it's great to have you out here from Boston. Thanks for joining us.
Thank you very much.
Let's just start with how you got into emerging markets. I understand that there is actually an interesting story about how you became interested in them. So
it's an unusual story because it's a personal story.
Yeah.
And the story is that my grandfather left Civil War Spain to start a business in Cuba that was nationalized in the Cuban Revolution. My mother left Peru after a bloody military coup, and I married a Russian refugee. So I've always been fascinated why some countries failed their people and why some countries succeeded. That led me to a career in emerging markets.
Wow, that's really interesting. Well, thank you for sharing that. Okay, so that's the story of how you got into emerging markets. From the investing level, I think the one thing that I tend to hear about when I do emerging market interviews is that there's the good news that emerging market stocks are cheap, right? And they tend to be, cheaper than their developed counterparts. But of course, the other bad news is that emerging market stocks have been cheap for most of the last decade. Is there any reason to believe that this coming time will be different?
You're obviously indirectly asking the question, will emerging market equities start to outperform U.S. equities? And I want to point out a few things about U.S. equities. A disproportionate share of the returns of U.S. equities have been concentrated in the disruptors, in the innovative companies, the Metas, the Nvidias, the Apples. As a matter of fact, only 10 stocks year to date on the S&P 500 represent more than 100% of the return. It's been very, very concentrated, and every year it gets even more concentrated. And so the question is, at the starting point today, given that those magnificent 7 stocks, as what people talk about these days in the US equities, trading at 40, 50 times PE, on a forward-looking basis, do you expect the same kind of return profile that we've seen over the last 10 years? And I think the answer is it's improbable. And so that's point number one. And point number two, on emerging markets, we've had to contend with a lot of geopolitical noise. We've had to contend with so both the U.S.-China trade relations deteriorating, what's happening in Russia and Ukraine, also the Middle East. We've also had to contend with the Fed cycle, which obviously higher U.S. interest rates typically are radioactive kryptonite for emerging markets. But for all those reasons, though, I think there's reasons for optimism for next year. Certainly, we get the feeling that we're near the end of the Fed tightening cycle. We certainly get the sense that the dollar has peaked. And so from a cyclical basis, a lot of the emerging market central banks are already cutting. A lot of those emerging markets already look better from a 2024 perspective, whereas Europe is mired in recession, it seems, and the U.S. is sort of its own downshifting growth. So if China can stabilize its growth, which is a legitimate question mark, and the geopolitics don't rear its ugly head in 2024, there are reasons to believe from a cyclical basis emerging markets can outperform 2024. But remember what I said about the U.S. innovative companies. Their stories really began to explode, the Netflix and so forth, really began to explode in 2009 after the global financial crisis. Internet penetration in emerging markets today is where it was in the United States in 2009. A lot of those successful business models that represent potentially the future of emerging markets really are now only coming in their own. And so I think there's a lot of exciting stories to be told in emerging markets that perhaps haven't played out as much to the same degree as played out in the US.
You mentioned a lot of those macro factors, and that's actually what I had in terms of my next question. You've got EM central banks cutting interest rates ahead of the developed market peers. You mentioned the US being close to, if not already, at the end of the hiking cycle. You'd mentioned conflicts. So let's put this all together then. How do you balance all these macro factors when you pick stocks for your portfolio?
You ignore the top-down emerging markets at your own peril. This is an asset class where countries make mistakes. This is an asset class where, because a lot of the countries sort of import foreign savings to sort of square the circle between domestic savings and domestic infrastructure needs, need to come from that foreign money. And so the price of that external capital matters. And so it's very important to understand the country factor. In our view, it makes sense to invest in good countries. So start off with the discussion of, yes, we're bottom-up stock investors, but wouldn't it be better to invest in good companies in good countries? And so the way our process works is that we layer in our own views in conjunction with our emerging market debt team. Which ones are the most attractive countries? From both a macroeconomic standpoint, the ones that have made the right choices and continue to make the right choices, and also from a geopolitical standpoint. And so, for instance, some countries in emerging markets are going to benefit from the supply chain re-architecture away from China. That represents a tailwind for some of these emerging markets. And so I think you cannot divorce in this asset class, you cannot divorce. There have been many examples, for instance, a few years ago, Turkish lira was off 50-60%. No amount of brilliant stock picking could have evaded that sort of pain. And so pick the right countries, not the countries that are having trouble keeping the lights on, not the countries that like to skate on thin ice. Instead, pick the countries that have developed the right ecosystems to be able to grow and create the right operating environment for these companies.
Yeah, I remember that Turkish lira story. That was quite something. And continuing to loosen policy when inflation was so high. So I thought I'd touch on something as well that sometimes we hear about with stock picking processes, and that's using the benchmark. Obviously, we've got MSCI, there's S&P, there's all sorts of different options. But what role does the benchmark play in your stock picking process? And actually, how important is it to pick stocks outside of that benchmark?
I would say in emerging markets, the benchmark provider is at best lazy, and at worst shows a lack of imagination. There are a lot of great ideas that the benchmark provider misses. They have their own sort of rules in terms of how they choose stocks to go in. We think they miss a lot of the future. Mercado Libre, which is Latin America's Amazon, is not in the benchmark. C, which is the combination of sort of Tencent and Amazon in Southeast Asia, not in the EM benchmark. So the index provider over-indexes the past and under-indexes the future. So I think it would make total sense, if you want to find the best ideas in emerging markets, that you look a little bit beyond. And so our portfolio is about 35% in out of benchmark stocks. I'm not saying Apple, Nvidia, Unilever. I'm saying stocks that the benchmark provider has simply missed. That the overwhelming majority of the assets, we don't care where they're listed, we don't care where they're incorporated. We care where the story is driven. If the story is driven by emerging markets, we consider that to be an emerging market stock.
Speaking of those opportunities, I did note, reading through all the documents, that something like 50% of the fund is in technology or financials names. I'm curious, how are emerging market companies coping with this generally tougher economic environment, higher cost of servicing debt? Yes, they're cutting rates in EM central banks, but the US is still the big game in town. How are they coping with a tougher environment, and is that showing up in their earnings?
So I would say there's a lot of survivorship bias in emerging markets. We have gone through our own EM crises in the 80s, 90s, and 2000s. We've gone through the global financial crisis. We've gone through the COVID pandemic. I think a lot of the lessons that we learned back then have prepared us well for sort of more difficult times. I joke with my US colleagues that what Silicon Valley Bank, how it was structured, they would not have survived one single EM macro cycle. It was a very badly run operation. And so because of the survivorship bias, because of what's available, a lot of these companies are certainly seeing top-down slowdown, but not seeing crisis, not seeing a sort of need to sort of restructure their liabilities. Most of the companies that we invest in are pretty light in liabilities. Actually, some of them are even net cash. That's again one of the lessons, that you don't necessarily want to be over-levered heading into a weaker macro cycle. And so I think, yes, for sure, the cycle does have an impact, but it's not a situation where you worry about a banking crisis or you worry about sort of significant dislocation in company fundamentals.
You talked about how important it is to know countries. Let's zero in on a couple of the biggest ones, if you like, and that's China and India. I mean, China has been this EM poster child, right, for the last 2 decades especially. How do you view the Chinese opportunity today?
Certainly, China is facing a lot of challenges. Some of it's its own making, and some of it is not. Certainly, the rise of geopolitical pressure between U.S. and China is been one of the catalysts for deglobalization, which is a nice way of saying supply chain re-architecture away from China. That's a headwind because multinationals not investing in China sort of reduce that sort of export tailwind that China used to get. Number two, they're dealing with the excesses of the past economic model, so obviously the leverage problem in property and local government finance vehicles. But there's also the question of political governance in terms of certain private sector companies being targeted by the government. And so to navigate this, I would say you need to have a process that is not only bottom up, but also top down, but also consider corporate and political governments. If you don't, then I think you step on some of these landmines and run into some of these risks. So the question you're asking there, is China investable? And the answer I would give is, it is not unless you're willing to incorporate in political governance, which is, what is the regulatory and government framework these companies are operating in, as well as the corporate governance. Are the controlling shareholders, and usually in emerging markets, are usually a controlling shareholders, either the state or the family. Are they there for all shareholders, or are they doing national service, for instance? And so if you ask yourself those questions as part of an investment in China, I think you can navigate the great opportunities in China. We have come to the conclusion that the best opportunities in China are either earlier cycle companies, so the ones that are doing aligned with the Chinese Communist Party, domestic innovation, decarbonization, or common prosperity, but early in their life cycle, so they're not minting a lot of money and maybe get that knock on the door to ask for national service, or companies that are benefiting from the changing nature of consumption in China, and so more travel, more experience rather than goods. Those are where we find the opportunities, less so the platform stocks, which I think are going to get those national service asks.
All right, let's probe the not unless then. Is there a stock in Greater China that you think deserves the closer look, that deserves the not unless?
So I'm going to say an unconventional name, perhaps even one you've never heard of, New Horizon Health. And so this is one that's focused on, has created a cancer screening for colorectal cancer, which is actually the cancer that has the third highest incidence in China. So this is domestic innovation. It represents common prosperity in the sense that it's helping to level the healthcare experience between lower tier cities in China and the top tier cities. It helps the government healthcare spending go a little longer, further, because you don't have to do wasteful colonoscopies if this isn't a problem. And so this company has looked at the Asian population, DNA markers to determine your probability of getting colorectal cancer, and they have in their pipeline similar sort of screening for other types of drugs, other types of cancers. And as a result, this is early in its life cycle. They're just ramping now. It's not pre-revenue, but it's pre-earnings. So again, it's an unconventional idea, but one that we think is a multi-year story that plays well in terms of all the sort of risks that we talk about in China, but also has this great opportunity of unlocking a lot of potential as well.
All right, so that's China. Then there's India. How are you positioned in India?
India is, of course, expensive and only seems to get more expensive. India has a fantastic story. Across emerging markets, it's the only country that I could convincingly say is going to grow high single-digit GDP for 2 decades. You can't say that about South Africa. You can't say that about Brazil. You probably can't say that with conviction with Indonesia. And so and imagine if you find the right companies, they're going to be able to grow multiples of that because they're sort of gaining market share and so forth. So if a lot of these companies that we find can grow 15-20% convincingly for 2 decades, that's a pretty attractive picking pool. And so obviously they have demographics in their favor. The government has created the right ecosystem in terms of reforms, bankruptcy reform, infrastructure spending is happening. There's lots of reasons to believe that it's credible. But India is expensive, and so I think you have to choose your spots. And so I would say we're neutralist India, but with a very favorable view that if valuation is correct, either because of worries over hydrocarbon prices, they're one of the largest hydrocarbon importers, or for whatever political concerns. Obviously, there's an election coming up in 2024. But for whatever reason, I think the long-term story remains intact. We are very, very favorable to the India story.
Okay, so that's the India macro story. Is there a stock in India that you think deserves a closer look?
Paytm, a fintech company in India, a very agile entrepreneur who's had to change his business model a few times because of regulatory developments, because of the way the fintechs sort of developed in India. But basically, it's a digital payments company, facilitates digital payments, that now is able to sort of leverage the information they learn on transactions to be able to sort of offer credit to merchants that are underbanked or unbanked. And so this is what I mean by innovation in emerging markets. Innovation that they're using in technology in new and creative ways to solve old problems. These merchants did not have access to the banking system. They weren't filing income tax returns. They weren't making deposits in the banking system. So the banks were reluctant to lend to them. They were largely invisible to the formal banking system. But because of this innovation in terms of being able to capture financial transaction data, you have a good sense of what this merchant is about and sort of be able to lend against that. And they do it in a way that's actually very smart. They have financial banks that sort of work with them. And so it's a relatively capital-light model that does sort of banking to relatively unbanked part of the population.
Okay, so that's Paytm. So we've covered China, we've covered India. I'm curious if you could tell us about another high conviction position, maybe away from those 2 economies because we've covered them. Maybe tell us about another high conviction position and why you bought it.
There's a few ideas, obviously. There's a new bank in Latin America that's looking to sort of bridge the gap between the unbanked and unbanked in Latin America. There's Eing in Taiwan. So they're the technology wizards behind the Kindle. And they are the ones that coming to a store near you. So right now, all of the staff at supermarkets have to change the prices on the shelves manually. If you could replace that with digital screens, which is what they're going to do, and so they're offering for these companies a way to sort of save costs, salaries, and be able to change prices dynamically. And so this is a company that also it looks very attractive to us. So again, there's innovation in Latin America, there's innovation in Taiwan. These are very interesting companies that have very little to do with sort of the emerging markets of old.
See, this is what happens when you look outside the world that you know, folks. Just finally, Daniel, if I can, Views from the Top is designed to really probe the ideas of those who've been in the game a long time. Is there one thing you have learned in your investing journey, 30 odd years you've done this, is there one thing you've learned in your investing journey that you wouldn't have realized or had access to if it were not for the position that you're in today?
I don't have a PhD in chemistry or biology, and I'm not a doctor, but we have people on my team, the greater part of the organization, that do. And so being able to rely on experts, so I can navigate China-specific issues, I can navigate Brazil-specific issues, but the sort of understanding the science of a lot of these innovative drugs, I certainly am not able to. But being able to work with a team that can help you navigate those issues, they highlighted to us the opportunity in this GLP-1, this sort of weight loss opportunity, years before it became investable. And so we were able to get in on a Chinese company that actually shows a lot of promise in this innovative drugs, showing very promising phase 2 results. And so what I would say is there's a lot of change in this investment world. There's a lot of change and evolution in terms of what the right and attractive opportunities are. It's not just about commodities. It's not just about retailers. Sometimes it goes into areas where perhaps you don't have that core strength. Being able to leverage that from a large organization that has those strengths certainly made me a better investor.
Yeah, absolutely. Hey, Daniel, it has been fantastic to have you out here from Boston. Thank you for joining Livewire. Appreciate you joining us.
Appreciate it, the time.
And thank you for joining us. Don't forget that if you like that interview, you can go to livewiremarkets.com and subscribe to our YouTube channel. Thanks for watching.